Hi, everyone. We'll get started in 2 minutes. Hi, everyone. Good to see everyone here. Happy to chat today a little bit about what's going on with interest rates. The last webinar we did last month didn't quite have enough time to understand exactly what's happening in the marketplace, and we're having a better understanding of what the what the Strait of Hormuz being closed really means for all of us, for interest rates, et cetera. And there is a risk of things getting much worse before they get better, unfortunately. So we want to talk about that, talk about the history of what's been happening, a little bit of what's happening today, and some of the things that you can do to protect yourself from incidents that might happen around the world. So first, I want to talk a little bit about the history of something called the petrodollar. So many of you may be hearing about the petrodollar, and this is the first time that you're hearing about it. But the petrodollar is an important integral component of what's happening right now in the war in Iran. This actually started back in the 1970s, and basically what it was is that Saudi Arabia and the U.S. decided and agreed to have Saudi Arabia sell their oil in U.S. dollars. In return, the U.S. would actually provide protection, military protection to Saudi Arabia. This was at a time there was a lot of civil unrest in the area, and Saudi Arabia didn't really have much of a significant army themselves. And so they were looking at gaining some protection. What ended up happening is after Saudi Arabia started to sell its oil in US dollars, because they were the largest provider in that area, other countries started to fall suit, and they started making the US dollar the preferred way of buying oil around the world. This is actually something that continued to further along the concept of the US dollar being the world's reserve currency. If oil, which is one of the largest exports around the world, is being traded in US dollars, it causes a circumstance where then a lot of countries end up just holding US dollars. And the reason for that is actually the what's called the petrodollar recycling. So basically, if the U.S. is buying oil from Saudi Arabia, then what's happening is Saudi Arabia has U.S. dollars, and then what do you do with that? Well, do you trade that U.S. dollars in for its local currency and pay a bit of a cut, or you park it somewhere that they consider to be safe, like back in the U.S. And so then they're basically paying in U.S. dollars for U.S. corporations for services and technology to extract the oil. They're putting that money into the U.S. In order to put in the stock market to save the money there. They're investing the money into sovereign wealth funds, U.S. treasuries, different things like that. And also what ends up happening is if money is flowing into U.S. treasuries or bonds, it actually pushes the rates down. So if you're a treasury issuer or a bond issuer, and there's now a lineup of people at the door, and let's say that now you have Saudi Arabia and another other a number of other countries wanting to park their money with you, you wouldn't have to offer the same rate of return on those funds. You could lower the rate of return, and people would still say, okay, maybe a few people leave your lineup, but enough people would say, you know what, I'll still invest the money with you. And so this whole petrodollar system is important to understand that it actually has a depressing effect on interest rates, which is generally a good thing as long as the petrodollar continues to exist. But there are a couple of countries that are saying, hey, you know what, maybe we don't want this to exist. So countries like what's called the BRICS, which is Brazil, Russia, India, China, and then South Africa was added at some point, just a little bit after they formed the group. So BRICS is effectively it's a much larger number of countries now, but they're saying, hey, you know what? We don't want the U.S. To be the only way that oil is traded around the world. We want to ensure that maybe oil could be traded in Chinese yuan or something else like that. And I'll get to that in a moment when I start to look at what's happening today. But long story short, there is some pressure to maybe decouple the petrodollar, which is one of the considerations for risks that we're seeing in the marketplace right now, and one of the reasons that we may see interest rates rise. So, of course, on the current side of things, now we have a very quick backstory on the petrodollar and the oil situation in the Middle East. Let's talk a little bit about Iran. Of course, what's happening now with the war in Iran is causing a number of different things. We're obviously going to see slower growth, so that's less trade due to sanctions, and so we'll see a lower growth rate in general around the globe, in particular countries that do a lot of trade. Wouldn't affect Canada as much because we don't do a ton of trade with Iran, which is good for us. We'll see higher inflation for sure because the supply is being reduced, in particular the supply of oil. And I'll talk a little bit about why are we talking about oil so much. The reality is oil is in a lot of different things, and it causes significant inflation when you reduce the amount of oil supply around the world, and higher volatility. So markets start to fluctuate, and it starts to add what are called risk premiums into the market. So we see this in certain times where even interest rates may not actually go up. Like in COVID, we actually saw that the bond rates for a period of time had gone down because of the market risk. And at the very same time, mortgage rates went up for a very short period of time before eventually coming down later. So one of the market functions that we're seeing right now is that a lot of banks are starting to price in some risk premiums and saying, you know what, we're not sure where rates are heading, but we don't want to be a part of offering super low rates in this type of climate. We want to build in a bit of a risk premium and just see where things go. Now, the real issue that we're facing right now is the Strait of Hormuz. And so to give you some perspective, early reports were saying that maybe 20 to 30% of all oil around the globe passes through this strait. Most of the reports that I see now are closer to the 20 or 20, maybe up to 25%. But regardless, a 20% reduction in the flow of oil supply around the world is significant. It is not a small amount to be considering here. And what we've seen already is a massive jump up in oil prices. So for the longest time, for probably a couple of years now, oil prices have been hovering around $60, $70 a barrel, give or take, pretty consistently around that number. And then all of a sudden, we saw a massive spike up. So as of today, we're trading at over $90 a barrel. And for a while there, we'd even spiked up to about $110 a barrel. So there's obviously some concern about the Strait of Hormuz closing and oil prices going up. The concern is that we're perhaps not done yet because there's some additional concerns. And one of the things that I've been looking into and trying to understand a little bit better is how oil moves around the world. Now, oil is in these massive shipping, ships, container ships like this, and they move very, very slow. I don't remember what speed they move at, but I think it was 5 or 6 knots or something like that. So to put it in perspective, from the date that they would leave the Strait of Hormuz to most of the destinations or locations that would be arriving. It takes them about 30 days to arrive at many destinations and closer to about 45 days to get all the way to North America or other areas that are a little bit further away like that. And so it takes a long time for these oil tankers to make their way around the world. Now, one of the concerns now is that a lot of these countries haven't even felt the effect of the lack of oil supply yet. So in North America, ships have still been arriving that left 45 days or so ago. They're still arriving up until about now is the expectation, where now those ships aren't going to be arriving. And so the concern is that as this starts to filter into the system, and all of a sudden countries like, man, we actually are not currently receiving oil, that starts to create some concern, and that pushes the expected prices up. We've actually seen some countries like Sri Lanka actually said, you know what, I think they're enforcing that on Wednesdays you have to work from home, and then encouraging most companies to actually employ a total work from home policy. And I think even as children are only going to school 4 days a week instead of 5 days a week, trying to cut down on commuter gasoline and whatnot, just to get a bit of control over the oil issue and problem. So we're already starting to see some countries start to tighten up on supply, and obviously internationally there's going to have some demand challenges. Interestingly, I think this whole situation may actually benefit Canada from certain perspectives here, because we are very oil rich and gas rich. And if we turn on the tap and really start to accelerate the extraction and the sale of oil, it could actually be a strong thing for us moving forward. But at the moment, we're trying to look at what is going to happen to oil prices in the short term. And Canada's, of course, in the grand scheme of things, we're just a very small piece of this puzzle. And it does take a long time to set up oil refineries, set up extraction, be able to pull oil out of the ground. The second thing I'm watching and I'm very mindful of here when I look at what's happening to oil prices is that a lot of countries are starting to dip into their emergency oil reserves. So most countries have significant oil reserves, or relatively significant. And we're actually starting to find that they're dipping into this at the largest levels that they've ever seen. So even going back to like World War II and major concerns around the world, there's been the largest dip into emergency reserves with countries around the globe. So what's happening is it's creating a shadow supply, or a short-term bump up in supply that will only last for a certain period of time. And so the concern is that we have ships that are still arriving to their destinations, or have just started to no longer arrive. You have countries that are around the world pushing oil out and dipping into their emergency reserves to kind of cover the situation off, in the hopes that the Strait of Hormuz does not remain closed for an extended period of time. And then lastly, you also have the issue about the petrodollar that I brought up earlier. So interesting thing that I noted is that there was a moment where Iran said, okay, ships can pass through the Strait of Hormuz, but only if those ships are trading oil in Chinese yuan. And so this is another push for Iran to say, you know what, we don't want all oil to be traded in US dollars. How about we start to push our agenda of decoupling and dethroning the petrodollar system that has existed for the last 50 years or so. Now, as I mentioned earlier, if the petrodollar completely collapses, that would have a significant increase in interest rates. And it also could put the US, and to a lesser extent Canada, into a state of decline as far as our economic growth is concerned. In particular for Canada, it would be more of a offshoot effect, where it would really affect the US, because money would be getting sucked out and not going into the US at the same levels as we've seen in the past, which would effectively slow down their economy. And then the U.S. consumers and businesses would buy less Canadian goods. And so we might end up getting into a position where interest rates rise, and we also go into a bit of a recession, which would be a very challenging and difficult situation for the government to battle. It's often called stagflation, which is, okay, we need to lower rates because we need to spur the economy, but also we need to increase rates because we have inflation and we need to keep a handle on that. So we create a very large issue. And I frankly think that This is one of the biggest systemic risks that we are seeing right now. It's possible that this big push right now could be one of those things that starts the dominoes to fall with regards to the petrodollar falling apart. And if that happens, then we will see interest rates rise. Nobody really knows exactly how much, but the question of will rates go up or go down, most economists now are thinking, well, probably up. And the reason for that is, well, oil is in everything. It's in gasoline, it's in fuel for transportation, it's in oil for shipping via large cargo ships. Airfare, it's about 20 to 30% of all airfare costs is in the fuel. And it's also in plastics, chemicals, fertilizers. I think that we all underestimate to a certain extent how much oil factors into the entire global economy. And so the problem is that there's a lot of different economists and reports that are suggesting that crude oil may rise to $150 a barrel if the U.S. is going ahead with their blockade, and there's a lot of different things going on here. So this is one that I pulled up. Another one was saying about $150 if the Strait of Hormuz remains closed for any significant period of time. And a number of them have kind of given a wide range of anywhere from $100 to $200 a barrel. We're already at nearly 100 at the moment. And so it seems like there's some expectation if this situation does not get solved soon, that we may see an increase to oil prices in the next little while. Now, this is concerning because if we look at this chart, other than going back to primarily in the U.S. subprime crisis, where oil prices had gone up and inflation had gone down around that same time, and the reasons for that was, of course, the financial crisis around the world. It was one of those weird times where oil prices were going up and yet average inflation was going down. But for the most part, you can see a pretty direct correlation between oil prices and average inflation. It's because it's not just this direct cost that you see, like gasoline and stuff. It's also just anything that gets shipped, anytime you're flying, and in many different products. That's the primary issue. So if we start to look at it, and this is where things get really tricky, and you start to try to speculate, and I must admit, I was asking ChatGPT a lot of these questions. I was doing a lot of search on a number of different websites and opinions on this, and it's really hard to get a good gauge of this. But I'm trying to understand what is the correlation between, let's say, $150 barrel of oil, and then what does that do to the inflation, and then what does that do to bond rates, and what does that do to mortgage rates? And so I'm trying to kind of piece this together a little bit. And again, nobody really knows. But if oil goes up to $150 a barrel, a lot of the information I saw suggested that the inflation in the U.S. may go to about 6 to 8%, and in Canada probably with 3.5 to 4%. So in Canada, we probably wouldn't see as much of an impact to our economy as you would see in the United States, which is a good thing, of course. Now, that being said, then I looked at, well, what were the bond yields, therefore the fixed rates, when we had inflation around 3.5 to 4%? And so if we look at this and comparing this, the unfortunate thing is that the zone that we were most recently in, where we had inflation of 3.5 to 4%, the bond yields are 3.2 to 4.3, and the mortgage rate range was 5% to 6.5%. It was actually, the peak of mortgage rates. And so this here is the chart that's showing the core inflation and the 5-year bond. And so the bond rates are the light green, and then the inflation is the dark green line there. And so I kind of highlighted or took a bit of a snapshot of when the inflation was in a range between 3.5 and 4%, and we can see that the interest rate range it actually peaked at that moment. So it wasn't a great time, but interest rates between 5 and 6.5% during that time period. So that's obviously a concern. Now, what we've seen with the bonds, definitely a big shift up. So 30 days ago, actually 45 days ago now, we saw a massive jump up in interest rates for the bonds, and then early into March or by mid-March, we saw lenders eventually follow and start to increase interest rates. And so we've seen from the bottom to the top about a 0.4% increase to the bond yields, and we saw about a pretty similar increase to fixed rates. We've actually seen with some lenders, they actually bumped up even more than that. I have some banks that used to give us a 5-year fixed at 4.09%, and for a non-insured mortgage, insured mortgages could get lower than 4%. And all of a sudden, that same bank now, same client or same type of client is now offering 5-year fixed rates of 4.74, a really big jump up. So we're finding that some banks are really starting to peel back and say, you know what, we're just not going to play ball here. And we see some other banks thinking, you know what, we're going to increase a little bit, but not as much. And so we're actually seeing a much larger difference between the pricing with some lenders versus others, a larger gap than we've seen in the past. And so there is a bit of a dichotomy. We're finding that some of our clients that are renewing with certain banks are finding that the rates are getting offered are much higher than they are with other lenders. And we're finding there's a bit more movement at the moment. I will say for a period of time there, most clients with their mortgage renewal, it just made sense to renew the mortgage unless there was a reason to refinance or do something else. And now we're finding that it really depends on which bank you're with. So if you do have a renewal coming up soon, it's good to just let us know what rates you're getting offered, even if you don't want to refinance, but you're interested in just seeing what's out there. Let us know and we can tell you if that rate is competitive or not. So we know what's happened to interest rates. The question, of course, is like, what's going to happen moving forward and into the future? And so this chart is showing kind of like the best 5-year fixed rates and variable rates for a standard bank or credit union type of scenario here. And so this forecast curve, it's called, is predicting how much higher interest rates are likely to rise. And so it's looking at about a 0.4% increase to fixed rates over the next 1 year. And of course, it's banking on an increase to the prime rate of about 0.5%, meaning there's predicted to be 2 prime rate increases in the next 12 months, and then 1 more prime rate increase after that. So we're starting to see that curve get a little bit steeper. If I pulled up the chart just about 30 days ago for the last one, we still had a couple of lenders that had lower interest rates on the 5-year fixed rate. And so that gap was actually more like 0.5 or 0.6 over the next 12 months. But because most of the lenders have now raised rates, they're still predicting, by the way, more increases to interest rates. That gap is just a little bit smaller because now a number of lenders have already risen their rates. So this is now the curve that we're looking at, and this is what the market, the people that professionally bet on the markets are expecting. So we need to be mindful of that. So then I'd like to look at what is the math for most of our borrowers and most of our clients on whether it makes sense to wait it out and wait until the renewal comes up or to refinance early. So I just took an arbitrary $500,000 mortgage at a 5.25% interest rate for a 3-year fixed rate starting in May of 2024. A lot of clients are taking 3-year fixed rates around that time. So pretty common situation to have encountered. So we looked at it and said, well, if you were just if you're to refinance, then you of course would have a penalty, and we estimated on this case the penalty to break that mortgage would be about $6,500. Then we look at what's the interest rate between now and the current renewal date. So the interest cost to stay at 5.25% for the remainder of the term versus refinancing now into a rate of around 4.39 is what I used. That interest cost would be about $26,000 to stay the same versus just under $22,000 to refinance. Now, the biggest thing is if we expect the interest rates are going to rise by almost 0.5% between now and just over a year from now, then we want to look at, well, what's that cost going to be? Because if you get to stay at 4.39 for 5 whole years, instead of having to come up for renewal on your mortgage, and now you're renewing into a rate of, let's say, 4.89 when you renew it in May of 2027, well, you'd be paying for the remainder of that term between May 2027 and May 2020 or 2031, you're paying about $97,800 in interest, whereas if you were still at 4.39, you'd only pay $87,800 in interest. So if you look at the balancing act here, the refinance in this case actually does provide $80,000 of savings. It's quite significant, and it just protects individuals in the event that interest rates do rise. Now, I'm going to preface this and say that nobody really knows where rates are going to rise, but I do wish that we had the opportunity and more time and preparation to get clients ready for this bump up. I don't think that the war in Iran really was expected. and all of a sudden it came up, and then all of a sudden rates went up, and we are trying and scrambling to get anybody that we could in the door before interest rates rose. But we only had a limited number of days to do that. What I don't want to happen is that we leave things alone and then there's another bump up. It seems reasonable to expect that in the next few months, we might see another potential half-point increase. We already saw a lot of lenders go up about 0.5% with the recent bump up in oil prices. And if we see oil prices go up to some of the numbers that people are talking about in the next few months, if there's another bump up of rates of about 0.5%, it would make sense to pull the trigger for many people's mortgages, because there's likely to be a reasonable amount of savings to pull the trigger early, pay the penalty, and refinance, and then just have some security. That being said, we don't know where things are going to go. And so what we're offering and advising clients to consider is maybe it makes sense to just get a refinance pre-approval, we call it, where you do have to go through the full application. I'm sorry, it's a lot more work for you and also for us. But if you wanted to get this in the door and just have it, then what we do is we sit on it. And then if there is a bump up in rates again, then we just click the button, send it in, hold the rate, and then see what happens. If rates go up and then they come back down again, then we just keep riding it out and just wait it out. And we can hold it and decide if we want to pull the trigger or not. But if rates go up and up and up, then there's going to be a moment where we say, you know what, based on where rates have gone, here's the math. You're going to save X amount, and we will be able to go through that and provide that information. So again, it is more work for you to go through the application. It's work for us, and we don't know if we're going to be pulling a trigger or not. But I am concerned with some of the things that I'm seeing in the marketplace right now, and I don't know where things are going to head. But there's been a lot of talk about us already having hit the bottom for interest rates. And now we have a real reason why interest rates could be going up even further. This war in Iran is very inflationary, restricting the amount of oil traveling around the world. And so if anybody does want to get some feedback on what the numbers might be on their property, we can make some assumptions on how much rates would have to rise. So you can see, well, okay, rates only have to rise 0.25% for you to be in the money. That's not a lot. Maybe it makes sense. Maybe in some cases, maybe the rates would have to go up by 0.75, and you're like, I'm not gonna bother with this. I'm gonna take the risk. Rates probably won't rise that much in the next couple of months or the next year. It really kind of depends on your circumstances. But we're happy to do the math, run it, and see if it makes sense. It's pretty simple. All you'd have to do is send us a copy of your mortgage statement, and then we can run the numbers and give you some feedback on what those numbers look like. You can also, if you'd like to, you can always book a call with Brian too. He can kind of walk you through and go into some more details to see what those numbers might look like for you, and see if it makes sense to go ahead with it. Lastly, for those of you that don't know, I do have a book called Rockstar Real Estate Investing. We always like to give it away to people that don't already have it. If you, from friends, family, etc., are interested in a copy, feel free to reach out to us, send us a note, and we'll send a copy of the book in the mail. And then, of course, you can reach out to us if you have any questions. You can send us an email, especially if you do want to see rough numbers on whether it makes sense to do this refinance pre-approval or not. You can send an email to info@greenmortgageteam.ca, and then we can take a look and see if it's worth your time to go through this process to hold an interest rate for you. So I know this is a lot of information, and it's in depth, and I'm not going to pretend to be a worldwide renowned economist, but I've been trying to do enough, trying to do some research here and understand what's going on in the marketplace and what risks may be around the corner. I've been generally more of a variable rate guy for most of my almost 20-year career, and recently the last couple of years has given us some time to pause and think, maybe now is a good time to be locking in and just taking some risk off the table. And so, I'll open it up for some questions now. If you guys have some questions, you guys can post anything through the Q&A, and we've also got the chat. So I'll open up the chat and go through that. So the question is, what about variable rates, especially as the economy slows? Do you see them going up or down over the next year? Yeah, so even with the current expectations, there is a possibility that inflation is not as bad as we're expecting, and instead that the economy slows down considerably. I think that the reason that they're not expecting that to affect Canada as much is that we might not see as much of a slowdown, because if people can't, if oil's not coming out of the Strait of Hormuz, other countries are going to look for other sources of energy. And the good thing about Canada is it has a lot of energy. It may not be exporting enough of it, but I feel like from a political perspective, if that remains closed and there's more opportunity to export more natural gas, especially with the new LNG terminals that are almost fully online now, which is finally, it seems like it's been going on for years now. But LNG to export natural gas to places like China and Japan, who don't have a lot of sources of their own oil. And then also, of course, we do have a lot of oil ourselves. So I think the thought is, well, we might not have as much of a slowdown, but we would have the effects of inflation. And so there is still a opportunity. However, there's definitely a potential case. It just seems like most of the professional bettors are kind of betting more on the inflation outweighing the downside risk of a slowdown in the economy, given that it's primarily pertaining to energy, which is something that we have lots of. Question is, how long can you hold fixed rates for? So you can hold rates for 4 months. So it gives us quite a bit of time to just watch and observe the market and see if things continue to rise or if they're just going to stay flat. There's a certain point where, of course, we have to decide if we're going to pull the trigger or not, so that the rate hold doesn't run out. But you can hold the rate for 4 months, so that it gives us plenty of time to hold it. And also keep in mind too that when we take in the application, we don't actually click the button to send it in until the rates are moving up. My team hates it because we are always very busy when rates are moving up. Usually there's a couple of days there where different lenders are moving up different days. A lot of our team is working until 8 or 9 p.m. every one of those days to get 50, 70 rate holds out the door. And I suspect that this will be a similar situation for us this go around too, if something does happen. But it allows us, let's say that rates stay flat for a month and then they go up in a month from now, we effectively buy today's rates for 5 months, because if we wait for a month, then the clock doesn't tick until that rate hold is submitted. And so we buy ourselves a little bit more time by waiting until rates actually go up. I noticed actually there's no Q&A for this for some reason. So if you're wanting to ask a question, maybe just put it in the chat. Any other questions? I'm surprised I'm not getting more questions. There we go. So one question, currently I have a HELOC that is a revolving portion of 266 and an interest rate of 4.65. In June, I'll be picking up 388 more on this HELOC for condo investment. When will rates go up this year? If interest rates are going up, should I lock in the amount into a fixed rate or keep it variable on the HELOC? My recommendation would probably be to lock that money in. I think that it would make sense to be looking at locking it in, and the reason for that is that a line of credit is always a slightly higher rates than a closed mortgage. So if you just looked at variable to variable, if you're not sure about whether you want to go variable or fixed, if you don't plan on paying that debt off in the short term, and you're okay with having an amortized payment, because it's principal and interest when it's a mortgage versus a line of credit is interest only, then I would suggest that you probably lock it in and then get a mortgage rate. Because even if you went closed variable, you'll get a discount of prime minus 0.5% or so, versus right now you're prime plus 0.2. So that 0.7% spread on $266,000, you're going to be saving yourself, $2,200 a year or so in interest just by locking that portion in, and then the other 388 portion at 0.7% spread, you're looking at about $2,800 in interest savings. So it probably makes sense to lock that debt in. That would be my recommendation. I would probably consider locking into a fixed rate term and comparing that. Now, if your bank is not offering a competitive rate, or you can feel free to ask them what the lock-in rates would be, and then you can convey that to us. Because if your mortgage is purely a line of credit, sometimes you can even find that, hey, that lender's offering pretty high rates, and maybe I can move it to this lender who's offering more competitive rates. There might be an opportunity to even save some additional money by moving it to another lender. One key is when you lock in the money, you don't get a rate hold. But if you're moving it to a new lender, you can hold the rates for up to 4 months. And so that's another benefit, is that if you were working with us, we can actually get a rate hold with a new institution and hold those rates for 4 months for that. Whereas if you go to lock it in, they only offer you the rate for a couple of days, and so you'd have to decide if you're taking it or not at that time. Usually, it's about anywhere from 1 to 5 days they'll hold the rate for you. So yeah, I'd probably consider locking into a fixed if you're comfortable with that. If you're not planning on paying off the mortgage early, but it obviously depends on your circumstances. I've got a question here. What would you suggest with a renewal coming up in June? So there's a couple of factors when your renewal is coming up. Number one is, do you want to refinance for any reason? Do you need or want access to capital to pay off debts, to invest, to do renovations, anything like that? If your answer is yes, then you may want to go through a refinance anyways. If your answer is no, I'm happy just to keep the mortgage the same, I just want to renew it, then you would probably want to just talk to your existing lender and get an idea of what rates they have for the different terms. And then feel free to just email those over to our team, and we can very quickly assess and say, hey, you know what, that rate's really good. You should renew with them, or maybe you should make a move and move it to another lender. And we can tell you what the interest savings would be to move it to another lender. So I would reach out to that lender though in June, and feel free, if you want, you can always send us a quick hit synopsis on it and say, hey, my mortgage is coming up. It's this much. It's in June. It's with this lender. What should I do? With some lenders, we can help negotiate the renewal rate with you or for you too. Ian has a good question. Will the CUSMA negotiations have any effect? So CUSMA is what used to be called NAFTA, the North American Free Trade Agreement. Now it's still in the works, and we don't know what the outcome is going to be. The last time that I kind of checked on this news, it still felt like it was relatively stagnant and no clear indication of which direction this is going. This could be, and initially the CUSMA was a reason that we could see interest rates go down. We also could see a higher inflation if the CUSMA negotiations completely fall apart. Then that could also cause less trade between the two countries, or three countries, I guess, and it could be inflationary. So there is different, like I was mentioning earlier, with the variable rate being a potential play. The CUSMA situation could cause Canada to be in a real tough spot, and low economic growth, and maybe the Bank of Canada has to cut. But there's still an inflationary factor that's an issue here, and this is where the terminology that inflation is sticky comes from, because I think the problem is once you have some inflation in the system, it just seems to, like, as soon as you get it under control, something comes up and it's inflationary. It keeps pulling the inflation up. For most of my career, we never really had significant inflation that was being reported anyways, and that was a part of government policy with regards to how they manage interest rates. But it just seems like no matter what, almost everything nowadays seems to be inflationary. If this happens, then inflation is going to go up. If that happens, inflation will go up. It's kind of wild to me, it seems, but it is a concern. And so CUSMA could go either direction. At this moment, I feel like, regardless of what happens with the CUSMA situation, because we don't know, it's hard to assume that CUSMA getting resolved or not getting resolved one of those is a good or not good thing, because I could see them either scenario being good or bad. Question is, do you recommend 3-year fixed or 5-year fixed based on renewing now? So the math on it that we've been looking at is that generally the 5-year will outperform the 3-year fixed. It depends on the spread between the rates. Most lenders, the spread between the 3-year fixed and the 5-year fixed is anywhere from 0.1 or 0.2%. So if the 3-year fixed is 0.1 or 2 or 0.2% lower than the 5-year, the 5-year will outperform the 3. We can do a calculation. We have a simulator on our end that we're happy to send over. So we do this when clients are going through their renewal or trying to look at different options with us. We can send over a simulator that kind of shows, hey, if you take the 3-year fix versus the 5-year, this is the expected difference in interest based on the market predictions of how interest rates are going. So if I was to order them right now, the 5-year fix outperforms the 3-year fix, which outperforms the variable. That's based on the current expectations of where rates are heading, based on the chart that I showed you earlier on what's going on. Hey Leo, have a mortgage renewal coming up. What would you suggest? I'm thinking a good compromise would be a 3-year fixed maturity with 3 years maturity with a fixed interest rate. So yeah, I kind of addressed that. It is a balance point. That the one benefit to the 3-year versus 5-year is that the penalties are cheaper if you break the 3-year fixed versus the 5-year. But the 5-year is projected to save to be less interest, because if the interest rates are rising about 0.5% in the next 12 months and then about 0.25% each year for that. That means that in 3 years' time, the rates would be 1% higher. And so if you pay 1% more for years 4 and for years 5, then you've paid in total 2% more on that versus the savings. If you maybe are at 0.2% less or so in the first 3 years, you're only saving 0.6% over the first 3 years and you're paying 2% in the back years, for years 4 and 5. It might be a little bit less than 1% higher by 3 years' time, but regardless, the very quick math in my head there is that if your gap between the 3-year fix and the 5-year fix offering is not significant enough, then the 5-year should outperform it, as long as you don't break it early and end up paying big penalties in the 5-year fixed, which is a consideration too. If you want more flexibility, maybe if it's a rental, then maybe the 3 year is the best way to go. I have a variable renewal in January 1st, 2027. No need to have cash now. Should I wait or refinance? So interestingly, if you're in a variable rate mortgage and you would like to be in a fixed rate mortgage, as we put out our newsletter, the last 2 newsletters I've put in the lock-in meter, the out of 10, like how much should you be considering locking in a variable into a fixed rate? I've had it at about an 8 for the last 60 days or so. So if you're thinking that, hey, I do have a variable and I'd probably like to be in a fixed next time in my next mortgage, you can actually lock that variable in at any time with your current lender. So that's something that you should consider. You can always, of course, get a quote from your current bank on what that rate would be, and then if you want to just relay it over to us, we can let you know. It's usually tough to make it make sense to move it to another lender, because you'd have to pay a 3-month interest penalty to break it and move to another lender if you wanted to get it fixed elsewhere. But in some cases, if the rate that you are getting offered is really high, it may make sense to actually move it somewhere else. Aside from rates uncertainty, where do you feel we are in the real estate cycle in BC? Hit bottom yet, or more dropping? I'm feeling like it's probably more dropping. Depends on the asset that you're in. I've actually been dealing with, there's a few properties that some of my clients have been looking at, and they're in multiple offers. They're coming in hot, they're having a rate subject free and whatnot. So it's interesting to see that. But it's because the property and the product is the right product and it's priced at the right price. If it's not, then the product just sits. What I'm finding is that condos are sitting for quite a long period of time, especially higher end condos. So luxury condos are feeling it a lot right now. Larger condos in general are a bit slower. So that's an issue that I'm seeing right now. Anything that's brand new is also slow. So I actually feel that's an opportunity, maybe as a buyer, to find a brand new product, because the developer has a ton of product. They have to get it moving, either because their bank wants to get paid back, their profit and equity is locked in this project, and they have another project they need to get working on. So they need to get rid of that product. And also, I'm finding more and more foreclosure situations, especially like new product. There's a couple in Vancouver that I'm seeing are going into a foreclosure. So there's some opportunities to maybe buy brand new condos at a big discount. But I do feel like, personally, initially we were thinking that maybe detached might kind of flatten out and maybe even come up a little bit in the second half of the year. I still think that's possible. I don't think the detached is going to have significant further decreases, but now I'm wondering, maybe we still will see some decreases in detached, but I don't think it's going to be as significant, because I do find that there's a certain point where people say, no, I'm buying in. And so detached is a bit of a better floor underneath it. Condos, on the other hand, I'm worried about. I still think the condos have further to go, especially if it's a small condo in like Surrey. If you're in an area, in a micro area where there's a ton of product built. Brentwood is another area where I would be very wary of that, because there's a ton of product in that area. But then on this flip side, if you're looking at a condo in Kitsilano, they get like snatched up like that. Like paying people are just there's seven bidders. The winner is paying full price or more than asking price. Kind of depends on what we're seeing. So yeah, it's tough. Another question here. Hi, Kyle. Can you tell me what is the best 5-year fixed rate that you're seeing right now? So it really depends on a number of factors. Unfortunately, what I would say is if it's owner occupied, then there's a number of lenders that are at 4.39%, or some of them are a touch lower if you're fitting certain specific criteria. But there's very few lenders that are underneath 4.39. I have a couple of like international banks that have slightly lower interest rates, but also have more stipulations that, oh, okay, if it's this, if it's this, if it's this, then the rate kind of goes up. So it's hard to say exactly. But in general, around 4.39 is achievable for 5-year. And then if it's not owner occupied, then generally the rates are a little bit higher than that. And then 3-year fixed, you can get 0.2, or even have one lender that's closer to like 0.3% lower than that in extreme cases. So if it's a larger mortgage and fits a number of different criteria, we've got one lender that I've seen just today got 4.09% on a 3-year fixed. So a bit of a bigger gap there, 0.3% difference between the 3 and the 5. Good. Any other questions? You guys are all good? I hope it didn't scare you guys too much about interest rates. It's a weird time, and I'm trying not to fear monger about the situation that we're in right now, but there's also some inherent risks with the market that we're observing, and usually, for the most part, I'm a pretty optimistic guy that things kind of have a way of sorting themselves out and the rates come down. But what we're seeing right now, and diving into it a bit more, I'm like, you know what, there is another chance for another like bump up of a 0.5% increase to the rates. And so not that they absolutely will happen. The Strait of Hormuz could get opened up tomorrow for all we know, right? Last weekend it was open for 2 days and then it got closed again, right? So we don't really know. But if it gets closed and it remains closed for an extended period of time, there is a very serious risk that rates go bump up again. And this might be an opportunity to save some money if you get prepared in advance for it. So feel free to reach out if you guys want to run any numbers or look into that. But I'll wrap up the webinar. Thanks so much. Good to see a lot of friendly faces tonight, and looking forward to see you guys all next month. Thanks a lot.